So we must have been about here. If we were talking about points and mortgage interest, and did I tell you what form that comes on? What do you get sent?
1098.
Yeah, 1098, and that's got your, all sorts of information on it. It's got your interest for the year, it's got your taxes for the year, it's got any points, and I don't think I made this point about points, but you get it when you originally get a mortgage, but there's also something you can do called refi or refinance a mortgage, right? Where you're like, oh my gosh, rates have dropped a bunch, or whatever, and there's a lot of situations. And then you might have points on a refi. Here's the difference, is on a refi, you don't get to take them straight away, you have to amortize them over the life of the loan. Okay, so for example, if I refi, let's just try this really quick. So let's say my original mortgage was 82% of a $400,000 house. And then let's say, find something that works here. Then let's say that I paid this mortgage down to 326. Let's say this was a 4.9. And then I paid this down to 326 and I refi, this was a 30-year, I refi a 15-year mortgage on 10/3/18. And I pay, I buy it down with points, so I pay 2 percentage points loan origination fee to buy down my mortgage to 3%. Well, first off, why would I do that? I mean, that's a ton of money, 2% of, my mortgage plus all my other fees, right? Underwriting, title, appraisal.
The 3% over the life of the loan is way better than 5%.
I just did the math. It's pure math. If I run a loan amortization schedule at 4.9, I run it at 3%. I look at the next 15 years and the difference in what I'm going to be paying. We've been practicing that in finance. And then, obviously I've got to add on this cash out of pocket costs. And if the math works, then it makes sense, right? So calculate two things for you. One is point amortization for 2018, and then point amortization for 2019. And it is actually done on number of days. That's how the software keeps it up. So let's see. Hi, Tobin. Let me put this on Flex Cam for you. So I take a 30-year note and refi 15-year note on 10/3/18. It's a $326,000 mortgage, and I pay 2 points to buy the mortgage down to 3%. And my question is, or my point was, on a refi, you don't get to take your points all in the year. You have to amortize them. So just super quick calculation on what my deduction looks like for those 2 years. 326, 6520. So how do we do the dates? The days in October, 31 minus, what was the date again? The 3rd. So in October, there's 28 days. Right? Yeah. 6, so 89. 365ths. Is that right? Doesn't feel right. That doesn't feel right. So let's back up. Let's do 2019. How much is 1 year, full year of amortization? That's just a flat out take the points divided by 15 years, right? I'm feeling like this isn't, that I'm not doing this correct. Yeah, that wasn't correct. So never mind that. So for 1 year, how much do I get?
435.
Yeah, that's what I got. Okay. All right, so that's 6520 divided by 15 years. You've got to amortize it over the life of the loan. Everyone there? Katie? Can you ask a question? Do you know, do you know where the 6520 came from? $326,000 was the note, and I'm paying 2 percentage points of that is my loan origination fee. In other words, that's what I have to pay the bank or the underwriter well, actually not the underwriter, the bank, to buy down my note. So first thing you got to do is figure out the dollar value. Then the next question is, how much do I get? If this was an original note, I would just take that $6,520 all this year. Hey, you try it out. But on a refi, you have to put it over the life of the loan. So first thing I'm going to do is figure out what's just 1 year of amortization, far less impressive number. Then the second thing is that 89,365. What do I have to multiply that by?
435.
The 435, exactly. I was applying it to the whole amount, that wasn't right. So if this is 1 year, so this was correct, the total of October, November, and December.
And then your last year on the loan would be the other
Yep,
200.
yep. So yeah, much less impressive numbers from a tax write-off standpoint, right? $106, 435.
Too bad you couldn't pay for it that way.
Yeah, right. Yeah, that's not going to happen. Okay, and then the other thing to note with points on a rental is you always have to allocate points like this on rental property. Okay, you can't take them all. The only time you get all your points in 1 year is on original purchase of a primary residence. Okay. Education loan interest. This should be of, so clever this morning, of interest to you. Because this is an above the line or a deduction for AGI, which means all of you get it. If you have student loan payments and you're paying interest on them, it doesn't matter if you itemize or not, you get it, right? How much do you get? You get up to $2,500 a year. You take it against your W-2, whatever, and your phase out starts when your AGI gets to 65 grand or 130 if you're married. Pretty straightforward. And I don't know how, well, this loan must be used for tuition, room and board and related expenses. I guess if they cash you out of a loan, they don't track what you do with it, obviously, right? Whatever you want. So I don't know how anybody can track that. But technically, say you cashed out $3 grand and went to Chile, you're not supposed to take that because it's not released. But I don't really know how they would track that. I've certainly never asked a client, like, what did you use your money for? Okay, investment interest. We talked about this really quickly. Can anybody remind me what this is? Yeah, you borrow money to make money, right? So the key, there's lots of different ways that it can be handled, but the key is you can only take investment interest up to the amount of investment income that you earn that year. And so pretty easily, we know that's interest, that's in dividends, but you can't count in that calculation of investment income things that get preferential tax treatment, like what? Capital gains, qualified dividends. Anything that gets those lesser rates, you can't put in the calculation. So say I have $500 of interest income, I have $800 of investment interest expense, I can only take $500, I carry the 3 forward. Okay? You don't see a ton of this. Okay, charity. Charity is allowed as a deduction. You can contribute cash, you can contribute property. If you drive on behalf of charity, I had a little sister for years and big brothers and big sisters, and everywhere we drove together, you write off the miles, right? That's charitable contributions. Or if you drive for Meals on Wheels or whatever you drive for charity, you get 14 cents a mile. Critically, this third little bullet right here, this stops up people a lot. The value of the free use of a taxpayer's property is not deductible. The client that's got a nice cabin up on Flathead, and she lets her church group come up there. She lets the youth homes kids come up there. And they're like, we get $3,000 a week renting it. Why can't I write that off? Why can't they write it off? What do you think the problem is with that? Who assesses the $3,000 a week? And she's like, it's worth $8,000 a week because it's my house and it's cozy and perfect. And, so you have no way of valuing that. So if you let somebody use your stuff, there's no charitable write-off. It's just a gift from your heart. The critical thing right here, to be deductible, the donation must be made to a qualified recipient. And we don't need to look at it right now, but your framework right here is page 515. Who's qualified? Okay. Every morning I ride over the bridge, my favorite guy's sitting there. He's a reader. Do you ever cross the bridge by the university? He's always sitting there reading. He wasn't there this morning because the sun wasn't up on the bridge yet. But so some mornings you buy breakfast, some mornings you give him $10. Okay, you write that off. He's totally a qualified recipient, but not according to the IRS, okay? Because he's not a 501c3 entity. So you've got to register as a nonprofit. That's a really, really big deal. It's like a 30, 40-page application. And you have to make the case to the IRS why you should be granted nonprofit status. It's a really big deal. Okay? And you have to meet certain criteria that you're in. I think I've got it written down here. Okay, so this is also important too. If you're being solicited or you're considering giving money to somebody, I'm going to always make sure for myself and my clients that they're an exempt organization. And so the IRS publishes everybody that's been vetted through the 501c3 process. And there's a couple other caveats, but mostly 501c3. It's like, oh yeah, these guys are a valid, bona fide 501c3. So I've been working with Soft Landing, which is the folks that help the refugees land here and get sort of integrated into our community. And they just got their 501c3 status. So that's huge because now all of a sudden people can contribute to them. I mean, you could always contribute to them, you just couldn't write it off. But now all of a sudden it's like, oh yeah, we've got 501c3. So if you want to give money or goods to, then you get to write it off. So that's great.
Is this going away next year?
This is not going away. In fact, interestingly enough, we'll see some limits here. The limits are going up on how much you give. But honestly, how many people give away more than 50% of their AGI in a year? One time that I can remember in 25 years that his dad was terminally ill. And he started he didn't want his no good, lousy kids to have it. I didn't go down that road. I'm just like, but the Audubon Society was very, very excited. He was like an international birder. Yeah. So you can give away your household items and clothing, which lots of people do. You go to Goodwill, the first thing the guy says that unloads your cars, do you want a receipt? And they don't fill in anything. You can put in whatever you want, right? But there's rules associated with it. The products that you're giving away have to be in good condition, right? And then you have to, if you've got, let's see, I think the numbers are coming up. I think if it's more than $250, you actually have to have a signed, stamped on letterhead discussion of what it was that you gave. So it's equal to the fair market value at the time of donation, and this is how people roll. So what were your charitable contributions this year? Well, I gave away $2,000 worth of stuff to Goodwill. No, you didn't. Fair market value of your old couch and your shitty old clothes are not $2,000. You probably didn't even pay that for them in the first place. Maybe you did. Maybe you paid $1,800 for the couch and a couple $100 for the clothes. But you've had them for 20 years. So the fair market value is really what could you sell them on Craigslist for, right? So let's be honest, it's really like $180. Okay, people never want to hear that. They always, and then the other thing people said, that actually the number's $500 before you have to have the letterhead receipt, because I have 80% of my clients that I might give away $499 worth of household goods. Anyways. So then you get into all these really complex rules, which I'm honestly not going to dive into because, and I mean, in certain markets, I'm sure this is very common, but like in my world, people aren't giving away expensive artwork or stocks and bonds. I mean, they're either writing a few checks, they're driving around their little sister in the Brothers and Big Sisters, or they're, giving some stuff to Goodwill or Home Resource, right? But there's a whole set of rules. Just be aware, kind of behind the scenes. I'm not going to ask you to be responsible for this because I honestly couldn't explain it without like reading from the slides. But if you've got short-term capital gain property or long-term capital gain property and you gift it, like stocks or bonds or artwork, there's a whole slew of rules that goes around that because the IRS doesn't want you dumping highly appreciated things without ever paying any tax on the appreciation. So that's the general gist of it. And more gist. Oh, wait. No. Okay. So you're really not responsible for that. It's a little beyond our scope. So here's what I was talking about before, your limits of how much of your AGI you can give away in a year. If it's so the 501c3s, the nonprofit or the exempt organizations are split into two kinds of types. They're called 50% orgs or 30% orgs. And 50% orgs, you can give away up to 50% of your AGI, and it's what most of us would think about a nonprofit being. It's our church, it's our synagogue, it's the youth homes, it's United Way, it's Ronald McDonald, things like that. Versus 30% organizations, you can only give away 30% of your AGI in any given year. And that's things like the Kiwanis and Rotary and the Lions, and they're called non-operating foundations. So again, you really don't have people coming in that are pressing those limits.
What about like Bill Gates, who says he's donating all of his money? How does that work if Bill has only 50%?
So he's not getting deduction for the other part. And the thing is also, this kind of is just a really quick discussion. It's very interesting. When you do people's taxes, you know every bit of a detail of their life. You know their divorces, their births, their business, their failures and successes, their medical issues. And you can also, I shouldn't say this, but you can, I feel like I can, make some sort of assessment on like where their values are. So you come in the door, you're a doc, and the first thing you want to know is, how much on my third home can I deduct for interest? And I mean, valid question. So you do the calculation, and then you start going down, the line items, and it's like, so how much, charity, how much did you give? $499 went to Goodwill, of course. Did you write the checks? Any cash? Not really, but I let the kids from the church come use my cabin, or my ski lodge, whatever. So it's very, very interesting. People give for a lot of different reasons. That's a really cool story. He and Warren Buffett and George Soros, I think I told you this before, went and challenged other billionaires to give away half of their net worth. Right? And evidently there's like around 500 of them in the world, roughly. What percentage? And they did it. I mean, those three people did it, George Soros and Warren Buffett and Bill Gates have given away, I think Bill Gates has given away 98% of his net worth.
Yeah, but when he's got left, he's like,
Well, that's the point, isn't
I know.
it? Yeah, I'm sure he still has enough.
Yeah, right.
He'll be okay.
Yeah, and his heirs are gonna be fine. And he doesn't want to honestly burden them with that kind of wealth, which was part of the
I'm
pitch.
worried about the kids, actually.
No. No. Have you ever heard anything about this kid? No, not worried. So what percentage of the people of the world's 500, that's exactly the number, 2%.
You
10
don't get, you
10
don't get rich
people.
giving it away.
10 people and 8 of them were women.
Right.
8 of them were women.
But you don't get rich, I mean, that's the thing. Generally speaking, the insanely wealthy people are the most stingy. I mean,
That's a
very
broad
It's a very
generalization.
broad generalization.
There's lots of
but-
very generous rich people.
But there are a lot of people that got rich by keeping it all to themselves.
Keeping it for themselves and their heirs. So I thought that was really interesting. Yeah, 2% of 500 and 8 of them were women. So whatever that tells us about nature, nurture, I don't know. Okay, this is more of those limits. I'm not going to go through all that. Substantiation's a pretty big deal, as you can imagine, like telling you about the thing with the goodwill and the $4.99. You get, you really, this is something, if you do get some sort of audit, you're going to have, you're really going to have to produce receipts. So $250 or more, you need written substantiation. Clothing, household items must be in good condition. I don't know how they know that. If the charity gives you some sort of receipt that accelerates or intensifies the amount you should be writing off, they can get penalized. So there's a lot of documentation here. And then quid pro quo contributions are partly gift and partly consideration. So quid pro quo is when you gift a service to an organization, like I do soft landing stuff for free, instead of wanting to pay me. So partly a gift, but also partly compensatory from their standpoint. So you've got to have some way of allocating that time. Okay, this is a huge issue. We've got a group here in Missoula that does this. It's super, super cool. You have your old car, it's not worth anything, trade-in value, blah, 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 but it still runs. And you can give it to this organization, and then they have mechanics that do quid pro quo work on the car and get it running. And we've got people in town that put on the new tires and da-da-da-da-da. And then they take them to the vet, take them to one, and they have it down in the shelter so that they have a way to, get to work, take care of their kids and all that good stuff. So it's a phenomenal, but of course, like anything, people are like, oh, cool. I'm going to give them my old car and, take a $5,000 deduction. Well, that took about 2 years to figure out from the IRS. And now we've got a way to track it called the 1098-C. So if I give my car to a 501c3 organization, they're going to do one or two things. They're either going to sell it for cash because they don't need the car, they're just doing it for cash, or it's an organization specifically dedicated, like I just explained. If it's an organization that sells it, then you've got to actually on the 1098-C have some sort of proof of what that organization sold the car for, and that's what you get to deduct. Does that make sense? And it's also the same with boats and planes and other things that, I don't know, people don't need boats and planes, but I mean, in some worlds I'm sure they do. So you have to, this 1098-C is a big piece of it now, and you actually have to staple that to your tax return. It was such an area of abuse. Okay, so let's just kind of go through this. So Clem, we don't need to write it down, but let's just go through each of these. Donates $12.60 to a synagogue's youth group. He allows them to use his lake cabin valued at $500. He drives 1,000 miles on behalf of the YWCA, and he donates a vehicle valued at $950 to the shelter. The shelter sells the auto for $750 and issues a 1098-C. Which of those things do you think you can take? Actually, just jot it down and give me a number, please.
We just got an earthquake drill that told us that we were supposed to drop, cover, and hold on. but I had my ringer turned down, so I didn't do any of those things. Drop, cover, and hold on. So, yeah, anecdotally, what does that mean, cover? So drop, obviously.
Under something?
So you're not worried about that then hurting you?
I don't know, I've heard that,
I thought you're supposed to go to a doorway.
yeah,
No?
that's like getting under something, you're getting under the framework.
Okay.
or-
But we're not all going to fit in the doorway.
No.
So really only the strongest person that can push the other people out of the way get to stay in the doorway.
How many doorways are there, or how many things are in the building at this time?
Another thing that I don't know how to do, which we really should know how to do, is I think we've talked about this before. I would have no idea how to secure this room if there was some sort of crazy thing going on.
There's no procedures.
I'd probably go in that stairwell over there, if you can't get in those doors, so it works for a lot of different things.
Say that again?
To the stairwell right there,
You can't get in the door?
Yeah,
not
from
from the
downstairs.
outside downstairs.
Right, but if there's somebody crazy coming down the hall here with an AK-47, they can get in the stairwell right after you.
Bullshit.
But that's also the quickest way to the first floor.
That's true.
I will just say out loud, I would never be a hero. I would try and crawl in next to the PC there. Y'all are on your own. No.
It's all hide in that closet that nobody knows what's in there.
Is that a closet?
I don't know.
I think it's just another room.
It's probably, wow. That's not helpful.
Yeah, I don't know. I don't know what you, I think these doors lock though, don't you?
Yeah, but they're freaking glass.
Right. They're not helpful. And you guys don't even have like anything to get under per se.
Well, and.
Horrible
there's
conversation.
There's
You
two
guys are
management
lying.
Your own, I'm out.
Huh?
Well, and so there's two management points, so even if you hit on this wall from this door, they come
Yeah.
from that door, and vice versa. So
Terrifying.
There's no shade or anything.
Terrifying.
Well, it's funny.
Why are we talking about this?
Because they sent you an earthquake.
Oh, yeah, because of the earthquake drill.
How do we get derailed?
Oh, my goodness. Yeah, how do we get derailed? There's gonna be 6,000 to 8,000 people in Missoula today that want nothing more than to be able to carry their weapons everywhere they go. So we still do not allow them on campus here. But we don't allow weapons on campus, but there's a huge legislative pressure, obviously, from the NRA and the American Enterprise Institute, that you guys can all be concealed carry in the classroom, which is the day I'm done. That does not work for me. Here is a really bad grade, slightly unstable person. Yeah, no.
Everybody gets a good piece of legislation.
Oh, my God. Okay, casualty and theft losses. This is going away other than for people in federal disaster zones. So this whole area is incredibly technical and completely irrelevant as of now. The only time you can take a casualty or theft loss now is if you're in a federally designated disaster zone.
Like,
Yeah, well, like anywhere, like, you know, I mean, honestly, it's hard to say, but with, you know, the acceleration of everything that's going on, it's drought, it's floods, it's hurricanes, it's fires, it's, you know, we were a federal disaster area a year ago last summer.
What about
So,
like Superfund sites, is that considered like some sort of a,
I don't know if they actually get that designation or not.
I don't think so, but it was, I don't know.
Are you from Dearborn? Where are you from?
No, I live in Anaconda. for a while,
Anaconda, okay.
So,
So was that a designated?
I don't think so, but I never really, I mean, it never really affected my taxes, so.
Right.
But there are things you have to do, like scrape up all the surface dirt on your property and have new stuff put in because grass don't grow because the arsenic levels are too high. It's insane.
That's also worth mentioning, there's an initiative on the ballot right now, I-186,
Oh,
which
yeah.
talks about
Mhm.
whether or not, it's not, there's
so much misinformation on both sides. The people that are against 186 are saying it's going to stop all mines from coming in.
No, it's
Does anybody know what the
look at
initiative
what
really
the
says?
issues are.
Huh?
No, it just makes them get a proper idea of what.
They have to have a remediation plan.
Right.
Shocking. If I come in and pollute your water or your soil, I've got to have a plan to remediate it. That's all it says. I don't know. I mean, I'm not a mining engineer, but that sounds like pretty 101 to me. Although, who knows? Maybe it will cost jobs. Okay, so really the only thing I want to talk about is what a casualty loss is, because this does pertain for federal disaster areas. So it really means that there's been a partial or complete destruction of your property. Okay? And it cannot be something that's slowly, like erosion or termites or what else, mold, okay? In our camper. That's not, you're not going to ever get a casualty loss for that because it's a slow process. So it's got to be something that happened, your fair market value went down, partial or complete destruction, and it depends, different rules depending upon if it's personal or business. But again, I'm just not going to hold you responsible for this because it's gone, essentially. Okay, and then that last little section, we're just going down to Schedule A. That last little section is called miscellaneous deductions, and there's two little sections down there. Miscellaneous deductions that you have to phase out, 2% of AGI, and then miscellaneous deductions that you don't have to phase out. What was the other deduction that we had to phase out that we studied? On Monday, or Tuesday, whenever we were doing it last. Medical, under 10%? Okay, so this is the other deduction that's got an AGI phase out. But of the two kinds of miscellaneous deductions, these are going away. Yeah, the 2%. The 2%. Those with no limitation or no AGI phase out are staying, which are these 5 things. The only thing I've ever had in this section from anybody is gambling losses. But only up to gambling winnings. I don't even know what those other things are. I do, but I've certainly never had anybody come to me and go, I've got unrecovered annuity costs of death that I want to write off. I don't know what that is. So the only thing in my mind that you need to be aware of is gambling losses, and you would have to come to me and say, here's my, it's called a 1099-G, because you have gambling winnings. I think it's $1,300. Ding, 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 at the whatever Lucky Wells, they come and they get your social security number and they issue you a 1099-G. Okay? And then you can take your losses up to the amount of that winning, so it just nets you out, doesn't it? So if you gamble and you win and you get a 1099-G but you don't itemize your deductions, too bad for you. You pay tax on the winnings, but you don't ever get to write off your losses. How do you declare your losses, or how do you report it?
Put $20 bills in.
Supposedly, you're supposed to have some little notebook.
Oh, for every.
Today I smoked 8 cigarettes and lost $39. But people don't do that. They come in and they're like, oh my God, I got this 1099-G and I lost exactly that amount. Great, of course. So,
But probably in reality lost
More than that.
well,
Oh,
of course
yeah.
they did.
Unless they're professional,
Yeah, nobody's a professional gambler in Missoula.
not Missoula.
Although I did have actually a really good friend who's, she's from Thailand, and they love, not to categorize, but she and all of her Thai friends really love to gamble. They go up to Grey Wolf for fun all the time. And I mean, she hit $48,000. So, and then she's like, can I, write off $48,000 of losses against, I said, that's probably going to be, she probably didn't plug in $48,000 worth of $20 bills, right? So she's like, well, how much? Can't tell you that. So these are all gone. All gone. Tax prep, job hunting. Okay, let's see, how many? So I've got to be pretty close to the end here. 37. Okay, last big topic, and then we'll start working on our taxes. So the last big topic in this section is how do you fund education? And there's a number of ways that you do it. This is pretty important stuff. So the one way that you can use tax-deferred instruments to fund education are called QTPs, Qualified Tuition Programs. Have you ever heard of Section 529s? Anyone? They're, yeah. Do you have them for your kids?
Not yet, I will.
But you will.
There's
Yep.
also the ESAs
Mhm.
too.
Yeah. So when clients have kids, it's I'm all like, oh, congratulations, and you want to send for 529. What's that? So, but it's a way to start saving for your kids' education. You can put in $10 a month if you want. The thing with the 529, it doesn't look that lucrative upfront because it's not like an IRA. You don't get a deduction for it on your tax return. But what it does do, particularly if you start saving when your kids are really little, you've got a whole lifetime, all that interest and dividend accrues tax-free. Grandparents can put money into it. Nieces and nephews, grandnieces and grandnephews. I'm not a fan of buying stuff and putting it in the box and sending it across the country from Walmart. I'm like, do they have a 529? Let me put in a Christmas present into their 529, right? So anybody can pay into it. It's a great tool. If you have kids, I would heartily encourage you to ask your banker about setting up a 529. I think they're free. And you get $20, throw it in there, right? So, and then when you pull it out, the distribution isn't taxed, obviously. The thing you have to be aware of is when you pull money out of a 529 to pay for college, you can't use those same dollars towards any of your education credits, right? Same as when you pull money out of a flex plan, you can't use it for your medical deduction. So you can never double dip. So when clients come, or I did this for my kids, when you go to figure out how much your American Opportunity Tax Credit is or your Lifetime Learning Credit, and I paid $8,900 in tuition, if I took $2,000 out of my 529, I've got to subtract that right from the top okay, before I can do all the calculations for the credits. So you got to make sure to ask people that because they won't tell you. Not because they're trying to be deceitful, they just don't know that it's important.
If you get scholarships too, you can withdraw the amount of the scholarships as well without penalty.
Sorry?
You can withdraw from your 529 the amount, like if you got a $3,000 scholarship, you'd be able to pull out $3,000 without penalty.
Really?
Yep.
And not pay it to the school?
Yep.
I didn't know that. I've never seen anyone do that. Okay, and then again, like anything, if you go, people will sometimes, when they get financially strapped, go into their 529. I've been saving for 17 years. My car breaks down. I need a new engine, and it's $3,000. I go into my kid's 529. You're going to pay 10% penalty and taxes. Same thing as what? Same thing if you go into your IRA or your HSA or any of that. Super bad idea. And I just said this, you can't use the money from a QTP towards your credits. Then there's this other vehicle. Honestly, I don't know why there's so many vehicles. This is where people start to glaze over, right? Why can't we just have one way to save for college? Do we need 4 ways? There's 4 different ways. Okay, so let me just do, I can identify the benefits. So a 529, the huge benefit is there's no limits. So grandpa's like, I want to put 50 grand in your kid's 529. Have at it. He doesn't get a deduction for it. Now there's $50,000 growing tax-free, right? So that's pretty cool. It's not a vehicle at all if you're in college. It's a vehicle for those of you that have kids, or someday will have kids, that you want to start as young as you can and get everybody in the family, instead of sending tchotchkes for Christmas, putting money into it. ESAs are a lot less valuable. For years, this is all we had. I think like the first 10 years of my kid's life, this is all we had. And all you could put was $2,000 a year per kid. Oh, newsflash, that's not going to get you enough to pay for your, it helps, but it's not enough. This also is not deductible. I have no idea why you would choose to do this anymore when we have QTPs that don't have a limit, right? And also,
This guy phases out at higher income.
So who would set one of these up now that we have QTPs? I don't know. Then you get to school, now I'm paying for school, right? So those two instruments we just looked at were saving for school. Now I'm here and I'm paying for it. Higher education expense deduction is an above-the-line deduction, right up there with your self-employed health insurance and your IRA contribution and all those other things we've studied about, right? But what are the other two things that you might, so say, you work and you contribute to your own education, you pay $4,000 out of pocket this year. What are the three options that you each individually would have that would benefit you for your tax situation? What's one of them? Yeah, that's the number one most valuable, the American Opportunity Tax Credit, right? That's worth up to $2,500, depending upon how much you paid and how much scholarships and blah, blah, blah. But remind me, who can take that credit? Can you take it for yourself? Folks take it, who can take it? That's the beginning and the end of the story. Are you a dependent for somebody else? If you are, only they can take it. So you have to make really sure if you're in that situation where somebody's helping you with school, that if you make enough money to claim your own self, that they should just gift you the money and then you pay for it so that you get it. Otherwise, no one gets it. Okay? So number one most valuable thing, American Opportunity Tax Credit, you get your first 4 years of full-time school. And then that goes away. And then you either have the lifetime learning credit, which is only worth 20%, or this. And I think we've done it in software, we hit that manual recap, or not manual recap, that, what is it called? Auto
Optimizer.
Yeah, optimizer, that's it. You hit it, and it'll come up as an error if you haven't done that, right? Because it does all that math behind the scenes and pops out what's most valuable to you. I don't really barely ever see this come up. Normally it's one of the credits is what's most valuable according to the optimizer. This is a phase out if you get super high income. I didn't get far enough this morning in this chapter, but I sense that this phase out's going away. This benefits high income people. So this doesn't benefit high income people. The fact that there was a phase out, so say I'm high income, say I'm married, we make $700,000 between the two of us. All my itemized deductions start going away once my AGI gets to 313.8. So if I'm super high income, I could lose all my itemized deductions. So this was a very bad thing for high income taxpayers. I think this whole phasing out concept has gone away. So obviously it's beneficial to high income taxpayers. Okay, so let's talk about what we've got in front of us.